afternoon, ladies and gentlemen. Hopefully, you guys are ready for a very interesting afternoon with the FOMC meeting. Hopefully, nobody's doing anything stupid, trying to trade right before FOMC, the holiday week, trying to force trades at the end of the year. There's literally no reason for any of that. But it's going to be an interesting afternoon. So we'll go over a little bit of the expectations for kind of what I have for the FOMC meeting. A couple of different really awesome setups that if I end up doing anything else after this awesome year, those will be the ones that I'm looking for. So, all right, let's get into it here. But what are we going to be doing? Friday, we got public live day. Today, we're live publicly. And then next week, there's not really going to be a whole lot going on. This is really the last good trading week of the year. And even then, it's like, what are we doing? Like, we have FOMC today. You can't really do anything in the beginning of the week, even though that Rivian and Etsy crowd, those were all really epic trades to start off the week. But, ladies and gentlemen, let's actually do the, what do you call it? Let's do a little bit of a roll call here. So, what is it? I forget it now. What is it? I haven't done this in a while with you guys. What is it? It's like, say good afternoon to somebody in the live chat. If you guys would like to say good afternoon to me, I'd love to receive some good afternoons over here. If you guys are new to the stream, new to the channel, or new to the Discord community, my mentorship group there, let me know. I'd love to welcome you guys in here. We're going to be having some fun today. And as always, ladies and gentlemen, make sure you guys are hitting that like button on the way in. Costs you nothing to do it. Helps me out a whole lot. Getting these streams out to as many people who actually want to learn how to actually have long-term success in the market, not all the other nonsense that you guys see out there floating around it constantly. So, missed you? Dude, I've been live. What? Well, we didn't go live this morning because there was nothing to do, but first 2 days of the week we've been live. Let's see. Watching from work? Nice. All right. So just in general, I mean, the market's not really doing anything going to Powell here, which is exactly what we were expecting. Market's basically flat. I would expect Powell to come out today and give the 25 basis point cut. Again, I'm not really in the camp of we need a 25 basis point cut with all of the data that we see. Now, the only thing that you could actually use to point to, all right, you might need a cut is the labor market data. But other than that, you're not really seeing anything in retail sales, especially the inflation data that's pointing to the fact that we need more rate cuts right now. So we're probably going to get the 25. They're most likely going to guide towards they're going to be a little bit hawkish. I don't think they would come out and say, oh, we're not going to be cutting rates in January because they're going to get asked about it. And Powell's just going to say we're data dependent. We're just going to be looking at the incoming data over the next period and see what they're going to do until then. TikTok got banned. They've been saying that for a while. They can ban TikTok all they want. That's fine. If from a content creation perspective, TikTok is like the worst app. Snap is up. All right, here's what we also have to talk about here, guys. Like, I understand that like the market's open and a lot of people have those terrible habits and the gambling mentality of wanting to trade right now. Don't. Seriously, do not think. And this is I haven't tweeted this out yet or said it yet, but the you got to like think introspectively and think, why are you trying to force trades during like a really choppy FOMC week and going into the end of the year in the holiday period? It's probably because you didn't really do the things that you wanted to accomplish this year. And you're trying to really like shove everything in at the last minute to hope that your results are going to change. I mean, you guys have seen everybody in Less Trades More Profits with us just absolutely crushing it all the time. We'll talk a little bit about the details of the 2-week free trial that I'm offering you guys. But yeah, at the end of the month, that 2-week free trial is going to be done. At the end of January, prices are going to be going up significantly as well. I only want serious people in there. Again, it's on the alerts community. I'm guiding you through every single day how to see the markets exactly how I see them. And that's why you see so many of my students having so much more success than everybody else. Well, let's see. Let's see. You got charged today when it was? Logan, no, it is. I mean, those what do you call it? Those the codes and everything were sent out to everybody. So yeah, if you had the code and you entered the code when you hopped in, you're in there for free. So if you didn't enter the code, you're not in there for free. Let's see. Casino's closed for the year. It's not closed, but let's see. All right, guys. Again, keep smacking that like on the way in. Let's go through some setups here. If you guys want an image of like what a textbook A+ setup is, it's Roku. Roku is the like best setup that I have seen. The look of this right here, guys, if you guys have been through the courses, the educational curriculum, and been with me in the community for a while, like look at this. Look at how perfect this looks. So if I do anything, Roku's probably going to be something that I go for. Facebook looks good here. Baidu looks pretty interesting. UPST looks pretty interesting too. And again, you guys have questions, just let me know. Just let me know. We're going to have the interest rate decision coming out in about 10 minutes here. Logan, if you entered the code, then you should not be getting charged. So I can look at it, but maybe you didn't enter the code. It's possible that you didn't, because everybody else that entered the codes has it for free. The people that bought the courses. So let's see. Dude, Roku just looks so good. It's like I can't even like, it's just, the problem is that right going into FOMC, it could just like flash up and break. And I might just leave it alone because, again, guys, I'm up triple-digit percentages on the year. Why would I do anything right now? Like, seriously, what is the point? Like, we're not. There's no point in trying to go crazy into the end of the year here. Let's see. Oh yeah, that could be it too, Rogue. But yeah, Logan, just message me. We'll figure it out. No joke, super serious. I mean, the gains are serious. Like, you guys have seen it on Twitter, on Instagram, everybody. Like, that one message that I got sent, that like the one individual that was struggling forever, they finally came in, took advantage of the courses, hopped into the Discord, and is now crushing it. It's like, that's the point. It's like there's a reason why we only have 5-star reviews. But let's see. Yeah, I would not expect this could be a dud of a meeting. The only thing that I could expect to see happen, this has got to go here now. The only thing that I could expect to see happen is the market react negatively to a slightly hawkish Powell. Roku's about to break here, or it's looking for it. It's like, what, 84.43? I want this thing to chill out a little bit so that we don't have to look at this directly during FOMC, but we'll see. SCP and dot plot is way more important than the actual cut. Correct. Oh, do we get an SCP today? Oh, that'll be really interesting to see with a comparison of like this summary of economic projections to the prior. That will be very interesting. Romeo, what are you talking about, dude? Let's see. Because he shorted Tesla. Jeez, man. All right, yeah, we got about 8 minutes here until FOMC. The rate cut, the interest rate decision. UPST looks good too, but Roku's my favorite one by far. This thing just looks nasty. Like, really, really, really nasty here. So we'll see what we get with it. If there's anything that I'm looking for, it's Roku. And just like those of you guys that have been following along on Twitter, like, you guys saw yesterday, I tweeted out what ARQQ, and then that thing at open, or at one point today, ran up, I think 28-30%. You're welcome. This is the quarterly report. Interesting. I thought that would come out in January. Even if Roku breaks, you wait for tomorrow to see how it is. That's smart. Like that's, and I think this is one of the things that people just have to realize. It's like you guys think I call my group less trades, more profits for no reason. It's like, there's a reason why trading less, only taking A+ setups and focusing on swing trading over day trading is going to be so much better for you. And the proof's in all the results and in all the students in there. So 7 minutes here, ladies and gentlemen. It's going to get interesting. This is going to get very interesting. Ooh, 20 likes away from 50. Appreciate you guys. Thank you. Yeah, keep smacking that like button on the way in. Costs you nothing to do it. Helps me out a whole lot. Getting these streams out to some more people. Bitcoin not having a fun day today, but what's this one doing? I see. I don't even want to bring that one up. I'm just watching it in the corner. Baidu looks really interesting here too, guys. Like, if Baidu can get a break over right around 91, that would be an interesting one too. But next week, like, I will not be taking any trades. That's going to be basically a week off. Ideally, what I want to see is the market come down here. We can pull up SPX. We'll do it on this one so you guys can see the zone. I want to see this prior all-time high zone get retested on SPX, at least. Like, you kind of are flagging at the highs here, which is interesting. You do have some decent areas of support in here, but with everything just like really starting to consolidate at the highs, that, you guys know how I am with that. Like, it starts to freak me out a little bit. I don't like it. I don't like it. So I would like to see a little bit of a pullback, come down into the zone, and then start moving to the upside before I start to go crazy on anything again. Oh my God, Roku, stop. We can't have you doing this, going directly into FOMC. That's not nice of you. We can't have that. You're going to make me want to do something. I could always size it for 0 and have some fun. With it. But yeah, I tweeted it out. What trades have I given out last week or over the last 2 weeks, even for free? It was like Google over 1,000%, Tesla over 1,000%, Crowd was over 100%. I remember that one. Let me see if I can find this tweet. Rivian 350%. Good work on their tour. ARM 150%. Those are just the ones that we handed out for free. Like, these are filthy, guys. But yeah, after the interest rate decision, after we go through it, we'll talk a little bit more about that for those of you guys that want to start or stop failing in the market and just keep going through that vicious cycle of win some, lose more, win some, lose more. That's not, it's once you guys see it, you can't unsee it. So, all right, 5 minutes to go here. Also, oh, I have such a funny tweet for later too. Oh, I can't wait to show you guys. There are going to be people that think it's serious. Oh, and I told the Discord about it, what I'm going to do. Oh, it's going to be funny. Oh, I can't wait to use that picture. Let's see. Yeah, I like UPST again, not A plus, but looks good. Baidu, I'd give that like a B plus here. Meta, that B plus. About Roku, A plus here. Will there be a scooter giveaway? No, we're not giving away any scooters. Let's see. I'm giving away 2 weeks free. That's about it. Let's see here. I like the retest there on Bitcoin. I'd like to see some of the other things get a little more aggressive, but dude, Roku, you gotta relax. Roku needs to relax here. That's like the best setup that I've seen all week long. Rivian was a really good one. That picture? Yeah, that one. That one's going to be fun. Afternoon, everyone. What's up, Alpha? How you doing, man? So, market's coming up a little bit here into FOMC, but again, this is not the time to be trading. I think we go through this a lot, especially with the new people in the community. It's like, well, yes, obviously learning how to identify and trade and execute the multi-100 and 1,000% setups is important. But the most important thing is understanding when the times in the market are to not do anything and to just sit on your hands and wait for the setups to form. That's what's actually going to make you the money in the long run. It's not actually like because you got to think about capital preservation. We're all going to be able to see the really epic setups that form, but you have to make sure that you have more capital to deploy at those setups when they form versus just like chopping your way around, making those really silly beginner mistakes that a lot of people make. Yeah, Roku's it's like 10 cents away, dude. We have 3 minutes here for Roku to get going, or for FOMC, and then for hopefully Roku to relax. I think Lucid's back up today too. ARQQ, though, for those of you guys that were paying attention on Twitter, that one was epic. Some people weren't able to trade it, though. Like on, what do you call it? When did the joke start? With Powell? Oh, it's going to be a lot. I don't think we're going to be making too many jokes here. Oh, my God. Roku is just looking for it here. Let's see. We got 2 minutes. 2 minutes, team. Oh, 10 likes away from 50 on the stream. Thank you, guys. I appreciate it. Yeah, we'll do, again, Fridays are public live days. So if you guys want to hop back in here on Fridays, we'll be live. And again, I'm on vacation too. So stop talking about ankles, guys. You guys are wild. All right. Good afternoon. Well, he's definitely going to say good afternoon. That's for sure. So, all right. We got a minute left. We have a minute left, ladies and gentlemen. Let's see. So expectation right now is 25 basis points of cutting. We got to see what's in the SEP. That is going to be very interesting here as well to see what exactly is in the summary of economic projections, and kind of see how it differs from the last SEP. So we probably have 30 seconds to go here. Let's see. The tie color? Yeah, 40 seconds to go. All right, let's see. 50 basis points of cut. Are you crazy? Spy strangle? No. Why would we do that? What are we gambling now? That's insane. Well, yeah, but that's different, Ralph. There's no reason for him to say that when. What do you go? All right, 17 seconds. Here we go, ladies and gentlemen. Mine Roku. No, I'm waiting on it, dude. It's literally about to be FOM. Like, dude, It's right as the Fed meeting is, or right as the interest rate decision is about to come out. All right. Oh. Uh-oh. Look at that candle. Look at that candle. All right, let's see what we get on the feed here. Let's see what we get on the feed. Fed low. Yeah, so all right. So we got the 25 basis point cut. Yeah, confirmed 25 bips. I really have been interested in the SEP though. Fed cut rates is 25 basis points as expected. Cleveland Fed President Beth Hammack dissented. The SEP shows it. How does Nikki Leaks have that within 30 seconds? Oh, because he's got the dot plot. All right. Wait, no, because the dot plot. How does he know that? Oh my god. The S&P shows a solid median of 2 cuts in 2025. Officials also revised up their end 2025 inflation projection to 2.5%. Median long run dot rises to 3%. That means 3% is the new 2%, ladies and gentlemen. That is exactly what we've been talking about. Think about what we've been talking about with everything that's been going on with the data, with the Fed not being able to get inflation back down, not landing this plane here. That's only 50 basis points for the entirety of 2025 is what the projection is now. Market's not like, I love this. Kill it. Sell the market off, please. Sell it off. That's what I want to see. Sell it off. Let's see. All right, we're going to throw a new alert on Roku here above today's high now because it did hit the other one, but with this nonsense, it obviously did not like that. So, let's see what else we get here. Again, for those of you guys that are just filtered in, make sure you guys are hitting that like button. Costs you nothing to do it. Helps me spread these streams out to some more people here. Let's see what else we get. Yeah, so median rate forecast for the end of 25 was revised up from 3.4% to 3.9 for end of 26. Whoa, that's big. End of 26 is up from 2.9 to 3.4. End of 27 went from 2.9 to 3.1. So across the board, you're seeing Roku said no. If you guys were deciding to trade Roku right as the FOMC announcement was coming out, I don't know what to tell you. What do you expect? The dot plot? I saw the Nikki Leaks dot plot, but I didn't see the other one. Let's see. Ooh. Well, yeah, it's the same thing. That's kind of the same thing that we were talking about here. Because if you think about, well, you'd have to look at the comparison, but I think what I just read off is a little bit of a better way to like visualize it. Like the median rate forecast at the end of time. Again, the dot plot's going to show you like, all right, where does everybody stand? But the medians are really what's going to be important. So, all right, ladies and gentlemen, let's see what we get when Powell comes on in about 30 minutes. It's going to be interesting. So, market's not liking it here so far. Let's see what else we're getting. Baidu still looks good. Facebook still holding on. Roku still holding on here. So, we'll see if this thing wants to start firing off. Terminal rate still 3. Yeah, and 27. Yeah. So that, well, it was like, what was it? 2.9 to it was 2.9 to 3.1, I believe. Above the wick? No, it's right at the top. It's right at day high. I don't even know if I'm going to do it. If I do anything, it's going to be so size for zero that it's almost not even worth trading. Like, that's what you guys got to realize here. This is not the time to be trading at all. Zero. Do not be trying to force anything in this market. It doesn't make any sense. But it is really strong with the market doing what it's doing. The dollar's going crazy. We could look at Dixie here quick. Let's see. Ooh, that's big. That's a big move up in the dollar there. That is a big move up in the dollar. Yeah, Roku looks good. It's perfect A+ setup. So if you want it, you can size it for 0 and see what happens, but I'm really not looking to do a whole lot here. Oh, ball as well. I'm doing great, man. I'm on vacation. We've had a sick year with LTMP. Like, guys, up triple digit percentages on the year. If you guys saw that on Instagram, Twitter, I posted that for you guys. It's been great. Like seeing all of your guys' success all the time is just awesome. Like, there's nothing else like it out there. Everybody else is like, i- once you see it, you can't unsee it. That's really the best way to describe it. Market getting killed. Get off the 1 second. Nah, he's just playing around. Look at that. How big is this candle in terms of points? 20 points? Ooh, that's not what you want to see. Our yields up. Yep. There go yields. There goes the 10-year screaming back to the ups. Ooh, this is dirty. Still going to wait for Roku tomorrow. If you miss it, you miss it. Yeah, it's smart. That's a smart way to do it. It's holding strong right now. Like even if you're looking at this like right here, but that market drop right there is obviously not going to help anybody. But it's FOMC. Like, why would you touch anything? Where are we in relation to the prior all-time high zone? Because I think I have an alert on it. Yep, we're right there. Yep, come on. Go down there and hit it. Go touch it. 60 set. We're like 15 points away. I love that. That's all. I love that so much. Home builders are going to get wrecked. All real estate's not going to have fun. Airbnb, everything. Everything's going to start to struggle in that sector. RKT is going to get hit. Bitcoin probably isn't having that much fun. I would assume Bitcoin's not thrilled with this. Yeah, I mean it's not doing a whole lot, but yeah. What about gold? Is gold moving? Gold down on that. That makes sense. So, I mean, the Federal Reserve is kind of saying they are trying to get inflation under control. The problem is though, is what their expectation is now. What did they say? 2.5% or 3% inflation by the end of the year. I think that's a downside alert. So the Fed is calling this a soft landing. It's exactly everything that we've been talking about. It's the landing, but you're landing higher than ground level. That's what this landing is. So we got to wait and see how everything is going to filter out, but I like how this is looking right here. We're 5 points away on SPX here from hitting this. Go test the prior all-time high zone. That's it. This is exactly what we want to see. Kill the market, please. Because think about what this is going to do for us and everybody hopping into LTMP for next year. Market sells off. We get some curling and some pullback in some of these names. They start to flip their moving averages again. And then what happens? We all go nail multi-1,000% gains. So I think we can talk about that right now. I mean, guys, this is the last month that I'm offering a 2-week free trial to the mentorship community. Again, what's included in there, you guys get all the courses. So you get the Day Trading Mastery course, the Swing Kings course. You get the pre-market plans, the private live streams every single day, direct access to me to answer all of your questions. What else? The macro research reports. We're going to have a really big one for 2025. We haven't done one in a little bit just because like there really hasn't been much. It's been close your eyes and trade the setup and make money. That's really what it's been like. But at the end of January, prices are going to be going up. The reason for that is, again, I only want the most serious people coming in that actually want to learn. None of these people that are coming in that are just like, feed me alerts. It's like, you're never going to have success. Sorry. Like and from the amount of success that all the students have had and all, you guys can see it, like click the link that's pinned to the top of the live chat there. I can throw it in the live chat here for you guys. Let me see if I can do this. Yeah, there you guys go. Just go click that link, read the reviews, and you can see just like why everybody is having so much more success here than other places. It's all about having the confidence in knowing exactly why you're entering, why you're exiting, how you're going to manage the trade when you're in it. So, and then you can ask anybody in the live chat too. Those of you guys that are in the Discord, if you want to let everybody else know what your experience has been like, you guys can see it in the reviews though. Thank God we're testing this prior all-time high zone. Finally. Finally, guys. All right, let's see what happens here. It's about to get that alert. I love this. This is exactly what I want to see going into the end of the year because we're not really going to be doing anything in the market. Kill it. Sell it off. Give us better setups. So yeah, and you guys have questions like the other thing that's gonna start coming in January of next year is we're gonna start doing like trade recap videos. Because it's all like learning. I want to make sure that everybody fully understands everything. So, and again, this is the best place to come and learn to trade if you guys want to have long-term success. So if you guys are interested in that, make sure you guys take advantage of it. If not, you're probably gonna struggle a little bit more than you would have. It's just simple as that. You guys see the results all the time. Like what? Kimberly had what 2,000% trades in the last 2 weeks. We had new people coming in making 300%. I had that pinned post for a while about there was a message I got that was probably one of my favorite messages that I've ever seen. Just about like struggling, trying to do other things, scalping, and it's just like it's not working for you. And I go, I know it's not going to. But approaching the market in this way, taking advantage of these swings and everything the market has to offer, you guys are going to crush it. So everybody gets 2 weeks free, but that deal's ending at the end of the month, and prices are going to be going up at the end of January, so in February. This is getting nasty here to the downside. Tesla was delayed on the market move. Nice. Roku's still holding pretty well here, which is very interesting. There, it starts selling a little bit. So we're going to have Powell on in about 19 minutes there. So let's see. Let's see what we get. A change in the Fed's policy statement from its most recent perspective in November hints at questions inside the central bank over the timing of future interest rate cuts. The new statement says, in considering the extent of and timing of additional adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, obviously the evolving outlook and the balance of risk. That updates previous language that only referred to considering additional adjustments to the target range without discussing extent and timing, alluding to uncertainty over whether the central bank will continue with another rate cut at its January meeting or take a pause. They're going to be taking a pause. I could almost say right now so let's call it 75% certainty, they're going to be taking a pause. Let's see here. Let's see. Until Powell talks, it's roller coaster time. Well, yeah, I mean, they could eat this up, and this could just be the retest that we get here on SPX with this prior all-time high zone. But this is exactly what we wanted to see. Like, I can't tell you guys, like that's picture perfect what you want to see out of the market. So let's see what we get. Let's see, where'd Roku end up? Yeah, Roku ended up fading there. Let's see. We still drilling? No, not yet. I mean, we're in the zone. That's exactly what we wanted to see. He better wear the purple tie. He might. Where's Facebook? Facebook's still holding on. That looks good. Baidu lost it a little. UPST, I would assume, lost it. Yeah, that's fine. The UPST, that setup is starting to look a lot better now. Bitcoin's probably getting whacked here. If it's holding, that'd be interesting. It's doing okay. It's doing all right. All right, let's see. I have the audio up over here, but we'll see what happens. Well, I mean, it's just gonna start playing once they're ready to go. But This is what we want to see. Chop around a little bit in here, and especially next week, chop around at the bottom side of this zone here. Oh my God, it's gonna be a field day going into the new year, I think, if that's able to hold. If he wears a big red tie. I don't think he will. I don't think have we ever seen Powell with a red tie? It's usually not like red, green. Like, he's not gonna do that. Because he knows everybody on Twitter is gonna start losing their mind about it. So we'll see. We'll see what we get here, ladies and gentlemen. It's going to be fun. Oh, and again, as everybody's filtering in, make sure you guys are hitting that like button. Costs you nothing to do it. Helps me spread these streams out. We're gonna have a lot more YouTube videos next year too. I haven't posted any YouTube videos this week just because I'm on vacation. So we didn't even stream this morning. There was no point. Like, why? There's nothing to do until we figure out just kind of the overall tone of what this market wants to do going forward. So big impulse reaction to the downside here so far. But I think this is just the market's going to be now using this as an excuse to sell off, even though it should have anyway. Well, what do you call it? Daniel, remember, Trump and Powell don't like each other. They're not buddies. Because Trump tried to get Powell out. There was a lot of disagreement about what was going on during the taper tantrum in 2018. There's a lot of a little bit bad blood there with Powell and Trump. So we're still selling here. New lows right now. Does he get asked again about quitting? I don't think so. They might. Again, sometimes they ask pretty stupid questions, but he's already said, and Trump has already said, no, Powell's going to stay his, live out his term. So I would not expect that to happen, but somebody could ask a stupid question and be like, what do you think about this? And it's like, all right, man, we're really going to start talking about, no, he's not leaving. What does he go till? 2026? I think is when Powell's term goes until. Yeah, Trump and Powell do not mix very well. Yeah, there goes Roku coming down. That's still a filthy setup, though. I love it above 84.46. Just let all of this nonsense with FOMC shake out, and then that's still an A+ setup going into the end of the year, beginning of next year, even. Yeah, let's see. Was there anything else that we saw within the dot plot or anything that's interesting to us? I don't think there was. Oh, the unemployment. Let me actually look at this. Hold on. Let me see. I want to see the unemployment data. That's September. I don't want September. Hold on. I'll find it. Statement. Here we go. I want to see the unemployment projections, because if they are projecting unemployment, what the? Right. So for end of 2025, they revised the unemployment rate down from their September projection. That's interesting. Oh, we're drilling right now. Nice. There we go. That's what we want to see. Yeah, that's kind of what I wanted to see there. GDP up. So they revised GDP up. That's interesting. PCE. Wow. PCE, the September projection was 2.1. Now it's 2.5. Yeah, this market's not going to have fun on this at all. Zero. Core PCE 2.2 to 2.5. 2.1 to 2.5 for headline is big off of what do you call it? Off of the last SEP. Yeah, that's big. That's big movement there. You'll have someone ask him about the border. Dude, that would be the stupidest question. Because the problem is that if you think about the border situation from Powell's perspective, he can only think in terms of economic theory. He'll be like, well, and then he'll just say some nonsense. Ralph, oh, I bet you are. With all those puts you have, I bet you're having a field day. Will that make calls on Roku better? It doesn't matter, John. Like, it really doesn't matter. It's going to do what it's going to do. If it breaks, it breaks. If it doesn't, it doesn't. If this money has no positions open, kill the market? Yes. Because the reason why, like, it doesn't, well, first of all, it doesn't make sense to be in any positions right now. Second of all, if the market sells off, we all get to make a lot more money. God, why'd you get into Roku? Why are we doing that, guys? Relax. I'm telling you guys right now, if you guys were to come in and just look and see, you go through the educational content and you see these setups and how they fire off, you're going to be like, wait, why wasn't I doing this the entire time? That is the number one piece of feedback that I get in my like direct messages is, dude, like I was struggling. I came in and I started doing things this way. And like, I literally don't know why I didn't do this sooner. And I'm like, I know, like that's the point. It's better than anything else that's out there. There's nothing else out there like it. Like, where else are you going to get consistent 500 to 1,000% gainers? You just aren't. You like a lot more money? Oh, I know. Oh, I know. Facebook holding here, I really like this. Respecting the 10. This is going to be one that we look for. But again, with the market doing this, obviously, it's going to throw a wrench in some things. So we'll see. We'll see what we get. But yeah, everybody gets 2 weeks free. That deal is ending at the end of the month. This is not an alerts community. Do not do like if you're gonna come in and you're gonna be like feed me alerts, I'll just kick you out. I don't need people in there. Like I seriously don't. I do this to help you guys. It's super cheap. The only reason prices are gonna be going up is so that like more serious people come in. That's it. I obviously do not need the money. I just want to help you guys and make sure that you're taking things seriously. So you want to come in, get it, take advantage of 2 weeks free. There you go. Also, there's no upsells. It's not like you guys come in and it's like, oh, this is good, but this. No, no upsells in there. All right, I think it's time for the fun tweet. I think it's time. We got that impulse move. All right, I think we do it. Hold on. I think it's gonna be fun. Ready? I gotta hold on. I gotta craft it real quick. All right, hold on. Hold on. I gotta do this quick. It's gonna be funny. You guys are gonna enjoy this one. I'm telling you right now. Then I'll tell you guys on the stream the story of why this looks like this. But hold on, we're gonna have some fun on Twitter real quick. Hold on, I might have to do this a different way. I don't want to be really like cursing on Twitter. You're gonna troll you? Oh, the crypto trading. Hey man, you guys saw what happened with Shadow when we were watching that this week. That thing went nuts. Hold on. All right, I think that's how we do it. All right, ready? Here it goes. Okay, there it is. All right, I'll send the link to the tweet in here. I think I got you. Ready? This is gonna be fun. It's FOMC. We gotta have a little bit of fun, guys. We gotta lighten it up a little bit. You can't. Everybody can't be losing their minds all the time. Oh my God, we gotta trade. Lighten up. Relax. Relax. All right, I'll send the link to the tweet in here for you guys. This one could be a really interesting one. Wait. What the? Now it's on here. I don't know how I've done this. Now, all right, what the? How do I delete this? Delete. Thank you. I did it on the wrong computer. There. All right, there you go. All right, ladies and gentlemen. Go like that one, retweet it. It's a funny one. It's a funny one. Premium. Oh man, this is gonna be great. All right, I had to have a little fun. All right, so I'll tell you guys the story of this. I brought my entire setup, like my Mac, my monitor, everything. I brought everything down, and I open it up when I get here, and my computer, the screen is all cracked. Haters are gonna eat it up. Good. I don't care. Give me engage. Give me the engagement. But so my Mac screen is all cracked now. Like it's on the sides, it's all messed up. So I was like, oh, that's fine. I mean, this works. It's all right. Then I look at my monitor and I'm like, oh well, at least the monitor's fine. I turn it on and that's what I see in that image right there. So gonna need a new monitor, obviously. So we're gonna let that one go. Oh my god, people are gonna go. I feel like this one might go nuts. All right, let's see. Facebook coming back up. We got the market coming back up here. Where's Roku? Oh, it's flickering around, doing its thing. You mean that in a good way? No, I know it's gonna be fun. I mean, what are you gonna do? Hate on me? Like, I don't think I really have any haters on Twitter because I'm very rarely wrong. Like, if you understand the setup, like and you look at it and you see what we do and I tweet something out, like I very rarely does something I post on Twitter invalidate and be incorrect. So join the beast from within. No, I'd be really bad as Fed chair. I'd be the worst. I'd be like, yeah, it's all bad. It's all broken. But all right, team, we got 4 minutes to go until Powell starts talking. Remember, everybody gets 2 weeks free to the mentorship community. It's literally like I would say bare minimum, go click on the that link there and then go read the reviews. There's a reason why there's only 5-star reviews on there. If you guys are like, my whole goal is to make you guys all self-sufficient, and that's what we're doing. We have people like Alfie in there, able to identify their own setups, come in, I like share them with the group. Again, once you guys see this, you can't unsee it, and you're set for life. So you guys want to take advantage of that deal, go for it. If not, you're probably going to end up paying a much higher price once you end up deciding to come in, because prices will be going up at the end of January. So there you guys go. Make sure you guys take advantage of it. All right. 3 minutes to go until Powell. I've got it right here. Hello. Hi, Powell. So let's see. Dude, this is gonna be fun. I love trolling sometimes. That's one of my favorite things to do. Troll people. All right, let's see. Roku's still holding on there. That looks very interesting. Very, very, very interesting there. All right, let's see what we got. Let's see what we get here. We got 2 minutes until Powell. We're trolling. We're having fun. We have our A+ setups that we're looking at here, potentially in Roku. If it invalidates to the downside, whatever. Then we'll just look for stuff going into the new year. We have Facebook looking good, Baidu looking good. We have UPST. We're going to need a little bit more consolidation on that, but still looking good. Ooh, Bitcoin started to lose it there more aggressively. Thoughts on ARM after days of consolidating, respecting the 10 EMA? Yeah, I'm not going. Jabari and Josh, neither of those things would I be looking at. Brady, thanks for joining. Again, you don't have to join a member of the channel, but I appreciate it. The thing that you should be in if you want to do anything is to hop into the mentorship community there. But I appreciate it on YouTube. Thank you. All right, market back down. It would honestly be pretty hilarious if it round tripped today. I would laugh at that. The market's kind of been doing this recently, where it's like screwed around, it round trip, it does some weird things, and then we'll see. We will see here, ladies and gentlemen, if this thing wants to get a little spicy. This could get worse. Oh, I agree. I 100% agree with you. This absolutely could get worse. Let's see here. Dude, I can't wait until people start like yelling about that tweet. It's so funny. I crack myself up sometimes. To me, it's hilarious. But the fact that we've gotten down to this level, guys, I'm very thrilled about. All right, we don't have Powell on here yet. Let's see. Yeah, this is getting dirty. So ideally, we want to hold right here. But if not, this could get a lot worse. Which, again, this is exactly what we want to see going into the new year. Sell it all off. Give us good setups. That's what I want to see. Yeah, this thing's getting pretty nasty. And this is why we don't touch things. See? Look. Don't touch it until it breaks and we're not in FOMC trading period. Don't be a crazy person. Please, guys. Powell begins press conference. Here he is.
Inflation has moved much closer to our 2% longer run goal. We're committed to maintaining our economy's strength by supporting maximum employment and returning inflation to our 2% goal. To that end, today, the Federal Open Market Committee decided to take another step in reducing the degree of policy restraint by lowering our policy interest rate by a 1/4 percentage point. We also decided to continue to reduce our securities holdings. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. GDP rose at an annual rate of 2.8% in the third quarter, about the same pace as in the second quarter. Growth of consumer spending has remained resilient, and investment in equipment and intangibles has strengthened. In contrast, activity in the housing sector has been weak. Overall, improving supply conditions have supported the strong performance of the U.S. economy over the past year. In our summary of economic projections, committee participants generally expect GDP growth to remain solid, with a median projection of about 2% over the next few years. In the labor market, conditions remain solid. Payroll job gains have slowed from earlier in the year, averaging 173,000 per month over the past 3 months. The unemployment rate is higher than it was a year ago, but at 4.2% in November, it has remained low. Nominal wage growth has eased over the past year, and the jobs to workers gap has narrowed. Overall, a broad set of indicators suggests that conditions in the labor market are now less tight than in 2019. The labor market is not a source of significant inflationary pressures. The median projection for the unemployment rate in the SEP is 4.2% at the end of this year and 4.3% over the next few years. Inflation has eased significantly over the past 2 years, but remains somewhat elevated relative to our 2% longer run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.5% over the 12 months ending in November, and that, excluding the volatile food and energy categories, core PCE prices rose 2.8%. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The median projection in the SEP for total PCE inflation is 2.4% this year and 2.5% next year, somewhat higher than projected in September. Thereafter, the median projection falls to our 2% objective. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. We see the risks to achieving our employment and inflation goals as being roughly in balance, and we are attentive to the risks on both sides of our mandate. At today's meeting, the committee decided to lower the target range for the federal funds rate by a 1/4 percentage point to 4.25% to 4.5%. We've been moving policy toward a more neutral setting in order to maintain the strength of the economy and the labor market, while enabling further progress on inflation. With today's action, we have lowered our policy rate by a full percentage point from its peak, and our policy stance is now significantly less restrictive. We can therefore be more cautious as we consider further adjustments to our policy rate. We know that reducing policy restraint too fast or too much could hinder progress on inflation. At the same time, reducing policy restraint too slowly or too little could unduly weaken economic activity and employment. In considering the extent and timing of additional adjustments to the target range for the federal funds rate, the committee will assess incoming data, the evolving outlook, and the balance of risks. We're not on any preset course. In our summary of economic projections, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate, based on what each participant judges to be the most likely scenario going forward. The median participant projects that the appropriate level of the federal funds rate will be 3.9% at the end of next year and 3.4% at the end of 2026. These median projections are somewhat higher than in September, consistent with the firmer inflation projection. These projections, however, are not a committee plan or decision. As the economy evolves, monetary policy will adjust in order to best promote our maximum employment and price stability goals. If the economy remains strong and inflation does not continue to move sustainably toward 2%, we can dial back policy restraint more slowly. If the labor market were to weaken unexpectedly, or inflation were to fall more quickly than anticipated, we can ease policy more quickly. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. On a technical note, we lowered the offering rate on our overnight reverse repo facility to align it with the bottom of the target range for the federal funds rate, its typical configuration. Technical adjustments of this kind have no bearing on the stance of monetary policy. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Here we go.
Gina Smilik with the New York Times. Thank you for taking our questions. I wonder if you could talk a little bit about why officials think it's appropriate to cut rates at all in 2025 if inflation is expected to remain firm throughout the year. And what would you expect at this point the timing might look like? Would a January cut potentially be possible, or does a pause next month seem more likely?
Well, so let me start by saying why we cut today and then move to 2025. So I would say today was a closer call, but we decided it was the right call because we thought it was the best decision to foster achievement of both of our goals: maximum employment and price stability. We see the risks as two-sided: moving too slowly and needlessly undermine economic activity in the labor market, or move too quickly and needlessly undermine our progress on inflation. So we're trying to steer between those two risks. And on balance, we decided to go ahead with a further cut, and I'll give you some details on why. Downside risks to the labor market do appear to have diminished, but the labor market is now looser than pre-pandemic, and it's clearly still cooling further, so far in a gradual and orderly way. We don't think we need further cooling in the labor market to get inflation down to 2%. Job creation is now well below the level, or certainly below the level, that would hold unemployment constant. The job finding rate is low and declining, and other measures such as surveys of workers and businesses, quits, things like that, broadly show a much cooler labor market than we had in 2019. It's still quite gradually cooling. So we keep an eye on that. Inflation, we see that story as still broadly on track, and I'll tell you why. We've made a great deal of progress. 12-month core inflation, as I mentioned, through November is estimated at 2.8%, down from a high of 5.6%. 12-month inflation has actually been moving sideways as we are lapping the very low readings of late last year. Housing services inflation actually is steadily coming down now, albeit at a slower pace than we might like, but it has now come down substantially and it is making progress slower than hoped. And we've had recent high readings from non-market services and some bumpiness for goods. So I'll just say, so remember that we coupled this decision today with the extent and timing language in the post-meeting statement that signals that we are at or near a point at which it will be appropriate to slow the pace of further adjustments. You ask about 2025. I think that the slower pace of cuts for next year really reflects both the higher inflation readings we've had this year and the expectation inflation will be higher. You saw in the SEP that risks and uncertainty around inflation we see as higher. Nonetheless, we see ourselves as still on track to continue to cut. I think the actual cuts that we make next year will not be because of anything we wrote down today. We're going to react to data. That's just the general sense of what the committee thinks is likely to be appropriate.
Sorry, just one quick follow-up. Why, I guess, would you make those cuts? Like, what would be the trigger to cut?
So we're to cut further after this point. I would say it this way: we've reduced our policy rate now by 100 basis points. We're significantly closer to neutral. At 4.3% and change, we believe policy is still meaningfully restrictive. But as for additional cuts, we're going to be looking for further progress on inflation, as well as continued strength in the labor market. And as long as the economy and the labor market are solid, we can be cautious about as we consider further cuts. And all of that is reflected, to your question, in the December SEP, which shows a median forecast of down 2 cuts next year compared to 4 in September.
Howard Schneider with Reuters, and thanks for the opportunity to ask you a question. So this does seem similar to the dynamic in 2016 during the last transition to a Trump administration, where the committee saw slightly tighter policy, in part in expected anticipation of the fiscal policy stance that was seen evolving over the year. Some of it was a data mark-to-market exercise, and some of it was anticipation of fiscal. What's the split on this one? How much of this was accounting for inflation data that was coming in, and how much of it is expecting that there will be inflationary fiscal policy next year?
I'd say I'd point to 5 or 6 things, and let me start by saying that we think the economy is in a really good place, and we think policy is in a really good place. Let's remember that the economy is growing 2.5% this year, that inflation has come down by 50% from 5.6% to 2.6%. Headline inflation is 2.5% on a 12-month basis. We're actually in a really good starting place here. But since, so what's really driving the slower rate cut path? First thing is growth is stronger, right? The economy grew faster in the second half of 2024 so far than we had expected, and is expected to be above what our expectations in September next year as well. Unemployment is lower, and in the SEP you'll see that participants think that the downside risks are less and uncertainty is less. So that's more strength, right? Inflation is higher, as we talked about. Inflation's higher this year. It's also higher in the forecast next year. I'd also point out that we're closer to the neutral rate, which is another reason to be cautious about further moves. But then getting to your point, there's also there's uncertainty. Uncertainty around inflation, I pointed out, is actually higher. It's also in the case of some people, the way I would say it is this. Some people did take a very preliminary step and start to incorporate highly conditional estimates of economic effects of policies into their forecasts at this meeting, and said so in the meeting. Some people said they didn't do so, and some people didn't say whether they did or not. So we have people making a bunch of different approaches to that. But some did identify policy uncertainty as one of the reasons for their writing down more uncertainty around inflation. The point about uncertainty is it's kind of common sense thinking that when the path is uncertain, you go a little bit slower. It's not unlike driving on a foggy night or walking into a dark room full of furniture. You just slow down, and so that may have affected some of the people. But as I said, there's a range of approaches on the committee.
If I could follow up on that, you mentioned the risk and uncertainty indexes toward the back of the document. The upside risk to inflation jumped quite substantially. The only thing really that's happened, you mentioned that the disinflationary story remains intact, yet the risk weighting has jumped to the upside. The only real thing that's happened is November 5th in the meantime. Is it fair to say that that's what's driving the higher sense of upside risk on inflation?
Actually, that's not the only thing that's happened. What's happened is that our forecasts for inflation for this year, I think, are 0.5 higher than they were in September. So you had 2 months of higher inflation in September and October. As I mentioned, November is back on track. But once again, we've had a year-end projection for inflation, and it's kind of fallen apart as we've approached the end of the year. So that is certainly a large factor in people's thinking. I can tell you that might be the single biggest factor is inflation has once again underperformed relative to expectations. It's still going to be between 2.5 and 3. It's way below where it was, but we really want to see progress on inflation to as I mentioned, as we think about further cuts, we're going to be looking for progress on inflation. We have been moving sideways on 12-month inflation as the 12-month window moves. That's in part because inflation was very, very low measured in the fourth quarter of 2023. Nonetheless, as we go forward, we're going to want to be seeing further progress on bringing inflation down and keeping a solid labor market.
Chris.
Thank you, Chris Rugier at Associated Press. Thanks for taking the question. In September 2018, the Fed staff in the Teal book discussed a policy of looking through any new tariffs as long as there were one-time increases and inflation expectations remained anchored. Could you comment on if that analysis remains effective and any other thinking on tariffs generally that you can share?
So I do think that the September 2018 Teal book alternative simulations are a good place to start. I happen to have brought them here with me today. I'm sure you have them too. They're a good starting point, and I would just say, it's 6 years old analysis, but nonetheless, this is still, I think, the right questions to ask. And there were 2 simulations. One was seeing through, one was not. And I'd point there's some language in the see-through paragraph that says, it considers situations in which it might be appropriate to see through inflation, and then names some conditions that in which it might not be. In any case, this is not a question that's in front of us right now. We won't face that question. We don't know when we'll face that question. What the committee's doing now is discussing pathways and understanding, again, the ways in which tariff-driven inflation can affect tariffs can affect inflation in the economy and how to think about that. So we've done a good bit of work. All of us have, each of us has, and it puts us in position when we finally do see what the actual policies are to make a more careful, thoughtful assessment of what might be the appropriate policy response.
Great. And just a quick follow. Given the recent bout of inflation that we've been through, with consumers seeing how prices can rise and businesses seeing that they can raise prices at least for some time, does that make it a little bit riskier to look through tariffs? I mean, do you feel you have to respond more quickly to inflation threats, given what we've seen in the past few years?
So the main thing is, and this is also a point in these alternative simulations, is there are just many factors that go into how much tariffs will even go into consumer inflation. How persistent will that be? And so we just don't know really very much at all about the actual policies. So it's very premature to try to make any kind of conclusion. We don't know what will be tariffed from what countries, for how long, in what size. We don't know whether there'll be retaliatory tariffs. We don't know what the transmission of any of that will be into consumer prices. To your point as well, I wouldn't say that we know whether the last episode is or is not a good model for what happened. You pointed out we've just been through a period of high inflation. We've just gotten through that period. That's a difference. there was also quite a bit of diversion of trade away from China to other countries since that may have effects. I don't know. I just think we need to take our time, not rush, and make a very careful assessment, but only when we've actually seen what the policies are and how they're implemented. And we're just not at that stage. We're at the stage of doing what other forecasters are doing, which is kind of thinking about these questions, but not trying to get to definitive answers for some time.
Nick Timrose of the Wall Street Journal. Chair Powell, to make sure I understand, participants today revised up their core PCE inflation projection for 25 so that the central tendency runs from 2.5% to 2.7%. And as Howard noted earlier, most of the committee sees the risks to those projections to the upside. So if inflation only declines next year from 2.8 to 2.5 to 2.7, what would compel the committee to be cutting in that situation?
Let me find these numbers. So we have inflation coming down, core inflation coming down to 2.5 next year. That'd be significant progress. You see a slower path. I think that does take on board that we want to see real progress, but we'd be seeing meaningful progress to get inflation down to that level. That wouldn't be all the way to 2%, but that would be better than this year. This year will be 2.8 or 2.9. That would be meaningful. We also have to think about the labor market, and while we have the labor market forecast as being in good shape, we are also mindful that it is still out there very gradually cooling so far in an orderly, gradual way. But it's also something we need to keep our eye on.
I guess if I could follow up, if somebody looked at these projections and also the insertion of the extent and timing language in the statement, which has been used at times in the past when the committee thinks maybe it's going to be on hold for a while, and they said, gee, this looks like it could be the last rate cut for some time, would they be mistaken to infer that?
So that's not any decision that we made at all. Let me explain extent and timing. So the sense of that wording is to make clear that if the economy does evolve about as anticipated, we're at a point at which it would be appropriate to slow the pace of rate cuts. So extent, that just relates to how much further we can reduce our policy rate consistent with getting to a neutral stance. Clearly, that distance has shrunk by 100 basis points, so it's significantly smaller. So that's the extent question. And we're going to be looking for further progress on inflation as well as a strong labor market to make those cuts. Timing just suggests again that we're at a place where we assuming the economy develops as expected, we're at or near a level that will make it appropriate to slow the pace of adjustment. So that's what we mean by that. We're not trying to make decisions about the longer run. We're trying to make sensible policy as we go. And I just would emphasize the uncertainty, which is it's just a function of the fact that we expect significant policy changes. There's nothing really unusual about that. I think we need to see what they are and see what the effects they will have. We'll have a much clearer picture, I think, when that happens.
Michael McKee from Bloomberg Radio and Television. Even though you've cut rates by 100 basis points this year, we haven't seen much change in mortgages, auto loan rates, or credit card rates.
Yeah.
You
why?
say you're significantly restrictive. Are you running a risk that the markets are fighting against you and the economy could be more at risk of a slowdown than you anticipate?
So the rates that you talked about are really longer run rates, and they are affected to some extent by Fed policy, but they're also affected by many other things. And longer rates have actually gone up quite a bit since September, as you well know, and those are the things that drive, for example, mortgage rates more than short-term rates do. So we look at that, but we look at all financial conditions, and then we look at what's happening in the economy. So what we see happening in the economy, again, is, most forecasters have been calling for a slowdown in growth for a very long time, and it keeps not happening. So we're now well into another year of growth that looks like it might be 2.5%. Second and third quarters were right about at the same level. So the U.S. economy is just performing very, very well, substantially better than our global peer group. And there's no reason to think a downturn is any more likely than it usually is. So the outlook is pretty bright for our economy. We have to stay on task, though, and continue to have restrictive policies so that we can get inflation down to 2%. We're also going to be looking out for the labor market. We want to keep the labor market pretty close to where it is. We're pretty close to estimates of the natural rate of unemployment. Job creation is a little below the level that would keep it there, but nonetheless close. And so that's what our policy is trying to achieve.
If I could follow up by asking about your formulation for beginning rate cuts, included the phrase, we need to have confidence that inflation is moving down towards our target. Given the fact that you've raised your forecast for next year, do you have confidence or are you uncertain about the path of inflation going forward?
So confidence was our test for raising rates. And, we made, look at the broader sweep. We've made just a great deal of progress. We're well into the twos in core inflation and around 2.5 or even lower than that. We have been for headline inflation. So I would say I'm confident that inflation has come down a great deal, and I'm confident in the story about why it's come down and why that portends well. And I'll tell you why. You do see with housing services inflation, which is one that we've really worried about, it really has come down now quite steadily at a slower pace than we thought, 2 years ago. But it's nonetheless steadily coming down as market rents, start to equilibrate better with new leases that turn over, not new tenants, but new leases. Market rents is new leases. So that's happening. That process is ongoing pretty much as we expect. Goods inflation, which is another big piece of it, has returned right to the range where it was before the pandemic. Just for some months this year, it kind of moved up in a bumpy way because of used cars and things like that. But we think overall that should generally be in the range it was in. That leaves non-housing services, and market-based non-housing services are in good shape. It's non-market services, and those are services that are imputed rather than measured directly, and they don't. We think they don't really tell us much about the about tightness in the economy. They don't really reflect that. A good example is financial services, which is really done off of asset prices. And that's how that inflation works. So the overall picture, the story of why inflation should be coming down is still intact. In particular, the labor market. Look at the labor market. It is cooler by so many measures now, modestly cooler than it was in 2019, a year when inflation was well under 2%. So it's not a source of inflationary pressures. Not to say there aren't regional and particular professions where labor is tight. But overall, you're not getting inflationary impulses of any significance from the labor market. So what's the story? The story is still just we're unwinding from these large shocks that the economy got in 2021 and 22 in, for example, housing services, and now also in insurance in particular, where costs went up, and those are now being reflected later in housing insurance. It's real inflation, but it doesn't portend persistently high inflation. So we and most other forecasters still feel that we're on track to get down to 2%. It might take another year or two from here, but I'm confident that that's the path we're on. And, our policy will do everything it can to assure that that is the case.
Colby.
Thank you. Colby Smith with the Financial Times. So the unemployment rate as of November, while still very low, is within spitting distance of the level that generated a lot of concern about the labor market over the summer in the lead up to the 50 basis point cut in September. Hiring has also narrowed to just a handful of sectors. But now the committee appears comfortable skipping cuts at upcoming meetings. So what has changed about the committee's assessment of the risks confronting the labor market? Is there just less concern now on that front? Or is it just about there being more upside risk to inflation that now needs to be accounted for?
The unemployment rate is now the same as it was in July, 4.2%. It's moved up and down, but it's now the same as July. And job creation is lower than it has been, but it's been steady. It's not declining. It's steady at a level which as I pointed out a couple of times, is actually below the level that would hold the unemployment rate constant, but it's not so far below. So you might, if we have the break-even level right, and if job creation continues at that level in the establishment survey, then you would get a tenth maybe every other month kind of thing. So gradually declining. We don't have that kind of precision in this. So you're right, though. And I read out some of the reasons. We do think the labor market is still cooling by many measures, and we're watching that closely. It's not cooling in a quick or in a way that really raises concerns. I think you pointed out participants in the FOMC really thought that the risks and uncertainty had improved relative to the labor market, and it's because things have just gotten a little bit better. It doesn't, the unemployment rate flat and things like that. Nonetheless, we're watching it closely.
If the idea, though, is that no additional kind of softening the labor market is welcome here, what's to prevent that from happening if rates are still restrictive?
So what I said is we don't think we need further softening to get to 2% inflation. That's what I'm saying. Not that it's not welcome. We don't need it. We don't think. If you had a situation where inflation's moving around by a tenth every few months, that's, we'd have to weigh that against the fact that inflation has in recent months been moving sideways in the 12-month window. And so we've got to weigh on both. And at this point, for a while there, we were only really focused, mainly focused on inflation. We've now gotten to a place where the risks of the two are, we think, are broadly, roughly in balance. And so that's how we think about it.
Steve.
Mr. Chairman, I did not hear you use the word recalibration today. And I'm just wondering if the recalibration phase is over and what you might call this new phase and whether the criteria for changing rates is somehow different and higher than it was before. Thanks.
We're not renaming the phase yet, but we may get around to that. But no, I would say we are, though, in a new phase in the process, as I said. So, and that's just because we've reduced our policy rate by 100 basis points. We're significantly closer to neutral. We still think where we are is meaningfully restrictive. And I think from this point forward, it's appropriate to move cautiously and look for progress on inflation. We've done a lot to support economic activity by cutting 100 basis points, and that's a good thing. I support the decision, and I think it was the right decision to make. I think from now, we are in a place where the risks really are in balance, and we need to see progress on inflation, and that's how we're thinking about it. So it is kind of a new thing. We moved pretty quickly to get to here, and I think going forward, obviously, we're going to be moving slower, which is consistent with the SEP.
I wonder if I could follow up and ask you how much you or the committee are looking through some of the high numbers we've had in the recent inflation numbers. For example, cars being up maybe because of the hurricanes, eggs because of the avian flu, that kind of stuff, and then looking forward perhaps to housing inflation coming down as it did in the recent report.
So we always try to be careful about not throwing out the numbers we don't like. It's just an occupational hazard is to look, those high months are wrong. What about the low months? We have a very low month potentially in November. It's estimated by many to be in the mid-teens for core PCE. So that could be idiosyncratically low. We try to look at not just a couple or 3 months. We shouldn't have our position shouldn't change based on 2 or 3 months of good or bad data. We have a long string now of inflation coming down gradually over time. As I mentioned, 12-month headlines 2.5, 12-month core is 2.8. That's way better than we were. We still have some work to do, though, is how we're looking at it, and we need policy to remain restrictive to get that work done, we think.
Neil.
Thanks, Chair. Chair Powell. Neil Irwin from Axios. Financial markets have been very buoyant really all year. Is the committee comfortable with where financial conditions are, or do you see a risk that looseness in financial conditions could undermine progress on your inflation target?
So we do look carefully at financial conditions, of course, that's part of what we do. But, we really look carefully at is the performance of our goal variables and how are we affecting the economy. So what we've seen over the course of just take the last year, We've seen inflation, well, over the last couple of years come down a lot. We've seen the labor market cool off quite a bit. That suggests that our policy is restrictive. We can also look more directly at the parts of the economy that are affected by that are interest sensitive, like particularly housing. Housing activity is very low, and that's partly significantly because of our policy. So we think our policy is working, it's transmitting, and it's having the effects on our goal variables that we would want. A lot of things move financial conditions around, as you know, and we don't really control those. But I'd say we see the effects we're hoping to see on the goal variables and the places where we'd expect to see it.
So if I may, speaking of assets that have been buoyant, do you see any value or benefit in the U.S. government building a reserve of Bitcoin?
We're not allowed to own Bitcoin. The Federal Reserve Act says what we can own, and we're not looking for a law change. That's the kind of thing for Congress to consider, but we are not looking for a law change at the Fed.
Stanford.
Hey, happy holidays, Mr. Chairman. Thanks for taking our questions. I was wondering if you are satisfied with the way 2024 is ending, if you're confident that we've avoided the recession that forecasters were predicting as inevitable a couple years ago.
I think it's pretty clear we've avoided a recession. I think growth this year has been solid. It really has. PDFP, private domestic final purchases, which we think is the best indicator of private demand, is looking to come in around 3% this year. This is a really good number. Again, the U.S. economy has just been remarkable, and it's when in these international meetings that I attend, this has been the story: is that how well the U.S. is doing. And if you look around the world, there's just a lot of slow growth and continuous struggle with inflation. I feel very good about where the economy is and the performance of the economy, and we want to keep that going.
The other thing I just wanted to ask about was you guys have noted that the unemployment rate is still low. However, employment rates have fallen rather quickly. The prime age employment rate has fell by about half a percent rather recently. The question, I guess, is do you think there's maybe more downside momentum in the labor market than the unemployment rate alone is signaling?
I don't think so. No, I think overall, if you look at it, prime age participation is still very high. What's going on in the labor market is that the hiring rate is low. So if you have a job, you're doing very well, and layoffs are very low, right? So people are not losing their jobs in large numbers, unusually large numbers. If you are looking for a job, though, the hiring rate is low, and that's a signal of lower demand. It has come down. So we look for signs like that, and that's clearly a sign of softening, further softening. I didn't mention it earlier, but I think you can see an ongoing gradual softening in the labor market. Again, not something we need to see to get 2% inflation. And that's part of the reason that explains why we moved ahead today with the action, with an additional cut. So, but you take a step back, the level of unemployment is very low. Again, participation is high. Wages are at a healthy and ever more sustainable level, wage growth. And so the labor market, this is a good labor market, and we want to keep it that way.
Thanks.
Amira.
Thank you, Amara Moquay from Bloomberg News. I just want to put a finer point on the labor market. Can you keep the labor market this way, in the strong position that you have described, without further cuts? In other words, do you still view the labor market as needing support to protect against the further cooling?
We can't know that with any tremendous certainty. I will say that we think that our policy balances the risks. We think the risks are roughly in balance as between the two mandates. And we think the labor market is in solid shape. And when I say it's softening or cooling, it's a very gradual process. Job creations are meaningfully positive. Wages are, if anything, still a bit above what would be sustainable if productivity were to revert to its longer run trend. If you take into account the high productivity readings we've had, then wages are already at a sustainable level relative to 2% inflation. So I don't want to overstate the downside in the labor market, because if the downsides clearly appear to have diminished. nonetheless, it's one of our mandate goals. And, we pay close attention to it. And it's worth noting that it is still gradually cooling, gradually and in an orderly way. And that's how I would characterize it. And that's why we're paying careful attention.
Elizabeth.
Thanks so much, Chair Powell. Elizabeth Schulze from ABC News. As you've noted, the Fed is now forecasting higher inflation next year. High prices are still a burden for so many households right now. Why do you think it is that inflation is proving to be more stubborn than you'd expected?
It breaks down into a long answer if you want, but it just has been a little bit more stubborn. I think if you go back 2 or 3 years, many people were saying that to get this far down, we would have had to had a deep recession and, high unemployment by now. Well, that has not been the case. So, the path down has actually been much better than many predicted. And we've managed to have the unemployment rate remain essentially at its longer run natural rate, while inflation has come down from, core PCE inflation has come down from 5.6% to 2.8% on a 12-month basis. So that's a pretty good outcome. Why hasn't it come down? One reason is that just a technical issue around the way we calculate housing services, and that process has been slower than market rents are showing up more slowly in that measure than we might have thought 2 years ago. So that's part of it. I think there are other parts of the story, but what I think people are feeling right now is the effect of high prices, not high inflation. So we understand very well that prices went up by a great deal, and people really feel that. And it's prices of food and transportation and heating your home and things like that. So there's tremendous pain in that burst of inflation that was very global. This was everywhere in all the advanced economies at the same time. So now we have inflation itself is way down, but people are still feeling high prices. And that is really what people are feeling. The best we can do for them, and that's who we work for, is to get inflation back down to its target and keep it there so that people are earning, big real wage increases so that their wages are going up, their compensation is going up faster than inflation year upon year upon year. And that's what will restore people's good feeling about the economy. That's what it will take, and that's what we're aiming for.
And as we look ahead to next year, what do you see as the biggest challenge to the economy under the next administration?
I feel very good about where the economy is. Honestly, I'm very optimistic about the economy, and we're in a really good place. Our policy's in a really good place. I expect another good year next year.
Edward.
Thanks, Chair Powell, for doing the questions. Edward Lawrence from Fox Business. So you say that we're closer to the neutral rate. What percent do you see and the committee believes? Where is that neutral rate?
So I'll say a couple of things. First of all, when we write, the thing we write down in the summary of economic projections is the longer run neutral rate, which is the neutral rate at a time when supply and demand are in balance, the full economy is in balance, and no shocks are hitting the economy. That is not where we are right now. So when we're making monetary policy at the Fed, that's not the question we're asking. So you can't do a straight read between those longer run numbers that we write down and what we think the appropriate policy should be. So basically, at any given time, various shocks are hitting the economy. And so what we're doing in real time is we're looking at our policy stance, and we're looking at the way it's hitting the economy. And particularly, we look at the effects it's having as we try to move the economy toward maximum employment and price stability. And the answer can be, there are things that affect the economy that are lasting, but not permanent. And the ones that are permanent are the ones that would be in our star. The ones that could be lasting, but nonetheless go away over time, they could actually affect what's sort of technically the appropriate neutral stance in near term. So we're looking at that, and we don't know exactly where it is, but as I like to say, we know it by its works. And I think what we know for sure is that we're 100 basis points closer to it right now. There are many estimates of where that might be, and we know we're a lot closer to it. And I think we're in a good place, but I think from here, it's a new phase, and we're going to be, cautious about further cuts.
But I think that the markets are looking for a little more clarity. I mean, I've heard estimates from 2.9% to 4%. I think the markets would like to see a little more clarity about a year out, 18 months out, as to where that goalpost, for lack of a better term, is, because at the moment it looks big.
Yeah, I mean, honestly, there are countless models of what a neutral rate might be at any given time. There are empirical models, there are theoretical models, there are things that combine them, and they have as many different answers as you'd like. So there is no real certainty. And I mean, it's actually a good thing to know that we don't know exactly where it is. So you're not tempted to think, oh, I think this model or this estimate is right. You just have to be open to the empirical data that are coming in, and also how it's affecting the outlook. And it's not made any easier by the fact that that our policy works with long and variable lags. Nonetheless, that is the job we have, and so I think it's appropriate for us now to proceed cautiously, now that we're 100 basis points closer to neutral, and we'll do so. Meanwhile, the economy seems to be in good shape, and these cuts will certainly help to support economic activity and the labor market, while we can still make progress on inflation, because policy is still meaningfully restrictive.
Victoria.
Hi, Victoria Guida with Politico. I just wanted to make sure I understood what you were saying at the beginning about inflation. Are you saying that progress on core PCE counts as progress on inflation, even if headline inflation ticks up? And then also, since that's what's projected in the SEP, I was wondering what accounts for that? Why do you all see core PCE going down and potentially headline inflation ticking up?
So, and as I imagine the goal overall is headline inflation, because that's what people experience. People don't experience core inflation; they experience inflation, and that includes food and energy costs. So that's the overall goal. But as we know, headline inflation contains energy and food, and those prices can fluctuate for reasons that are not related to tightness in the economy, and therefore are not really good predictors of future inflation. So it turns out that core inflation is a better predictor of overall inflation than overall inflation is. So we look at core inflation because it's a better measure of what future inflation is likely to be, because it's a better measure of what inflation pressures exist. So it's complicated, but ultimately our goal is headline, not core. So your second question was what?
Why do you all see core going down, but headline potentially ticking up?
So headline can be affected. You're talking about next year.
Mm-hmm.
Yeah. So headline can be affected by energy prices and food prices. So that there will be things in the headline forecast that are to do with forecasts of energy prices, whereas core will be, if you look at core going out a full year, then it'll be much more driven by things like tightness in the economy. So that's why the two can go in different directions. Headline has been lower, as you know, most of this year, but that's because energy prices have been coming down, which is a great thing for people, but energy prices will come down and then they will go up, and it won't really be telling us anything about how tight the economy is and how future inflation will perform.
Do geopolitical risks factor in at all to how you're thinking about energy prices?
We monitor geopolitical risks really quickly, but really carefully rather. But I would say so far those risks nothing has come out of those risks that has really been important for the United States economy. The single thing that you would look to is the price of oil, given that we're talking about the Middle East and Ukraine, but that is a good summary statistic for the kind of thing that could go wrong with global turmoil. But the price of oil has been coming down, and because of global supply conditions. So the U.S. is not feeling really the effects of geopolitical turmoil, but we are certainly at a time of elevated geopolitical turmoil, and it remains a risk.
Thanks, Chair Powell. Kelly O'Grady from CBS News. I want to go back to something that you said a minute ago, that wage growth is outpacing inflation now. It wasn't the case for some time, of course. It's partly why Americans haven't felt much relief in their wallets from prices yet. But with inflation ticking up, how worried are you the progress in closing that gap could go away?
Yeah, I So inflation, again, we don't overreact to a couple of months of higher readings or a couple of months of lower readings. And what we had was we had 4 months of really nice readings, and then September and October were higher, but then November is much lower. So I don't really think the public is experiencing that as a surprising upside risk to inflation. I think inflation is much lower. What the public is feeling, and they're right about it, is that prices are just, the price level went up because of the past inflation. And it's going to take some time for real wages to recover over a period of years in which your real compensation is growing. And in other words, your compensation is growing meaningfully faster than inflation. That's exactly the kind of economy we have now. And we just want to hold on to it. That process will probably take some years, but that's what's going on right now. And I don't think that a couple of months of higher inflation really signal that anything of the nature you're suggesting.
And just one follow up. Let's look more long term. You previously predicted hitting the 2% inflation target in 2026. It's now been pushed out to 2027. You said you're focused on enabling further progress on inflation. That's not necessarily progress in the right direction. Are you confident that target isn't going to move further out?
We're talking about when you're projecting the economy, 3 years out, 2 years out, you're talking about high uncertainty. Very high uncertainty. We really, at that point, that's not possible to confidently predict where the economy is going to be in 3 years. So what we're doing is we're looking at what's happening now. We're kind of projecting that the same kinds of things are happening. So we keep a strong labor market. Housing services inflation comes down. Goods inflation settles down, and non-market services return to their prior level. All of those things should happen over time, and those pieces come together. There's every reason to think that they will. The timing of it is highly uncertain. But you're not wrong though that it's been a bit frustrating because while we've made progress, it has been slower than we had hoped. Nonetheless, we're still on track. And I think if 2 years ago you'd said we were at 4.2% unemployment and 2.8% inflation, people would say, "I'll take that." I mean, that's a pretty good interim place to be. Job's not done, but I think we're feeling good about where we are and where we're headed.
Go to Nancy for the last question.
Nancy Pelosi. Sorry.
Hi, Chair Powell, Nancy Marshall-Genzer from Marketplace. You said a couple times inflation has been moving sideways, appears to be settling in around, 2.5%. Do you think the Fed is just going to have to settle for that and accept that you're not going to get to your 2% target?
Good question.
No, we're not going to settle for that. I think we certainly have every intention and expectations that we'll get inflation back sustainably to 2%. That is, and I am confident we will achieve that. It has taken longer, but you have to be, we are making progress. We have made a great deal of progress, and we'll continue to do so and get back to 2% inflation. That's what we owe the public, and we're committed to achieving it.
In that case, can you rule out a rate hike next year?
You don't rule things completely in or out in this world.
Crazy.
That doesn't appear to be a likely outcome. I think we're at 4.3%. That's meaningfully restrictive, and I think it's a well-calibrated rate for us to continue to make progress on inflation while keeping a strong labor market. So, thank you very much.
All right, ladies and gentlemen, that concludes the Q&A with Powell. And that was pretty interesting, but I think there's a couple of takeaways here. I'm not going to be able to make a video, obviously, today. So let's go through it. We are now projecting about 2 rate cuts going into the end of next year. The inflation projections are up. Unemployment projections are down. We see the dollar ripping here as well, and the market selling off. Now, why would the Fed right now, think about it, why would the Fed not be willing to decrease interest rates more? What is the reason for that? Well, the economic indicators are showing that the economy is a little bit hotter than they thought it was going to be at this time in this part of the rate cut cycle. So why would the dollar be ripping? Well, it's a flight into U.S. Assets again, or just into the U.S. dollar, because the U.S. is experiencing most likely more growth than these other nations. Now, you also have to worry about the inflation narrative, because we all know that 3% is the new 2%, but it's going to take some time for the overall market here to kind of come to that conclusion for themselves and say, all right, this is now we're going to be looking at that 2.5%, 3% as that long run target versus 2. And you're seeing it right now in the S&P. Powell can say whatever he wants about, oh no, our goal is to get down to a long run 2% target. But if in the S&P they are moving up their projections for inflation, the data speaks for itself. I mean, you can't really listen to Powell at that point. He's going to try and calm everybody down. So, but on the market here, I cannot describe to you guys how freaking excited I am that we finally got a sell-off and we're not chopping around at these all-time highs anymore. Like, you guys have seen, I think, just the amount of gains that are made when things start to curl back up and the trades that we're able to nail. It's very difficult to do that consistently, even though we have like last week, Google multi-1,000%. We had another Tesla multi-1,000% for you guys in there. Let's see. I mean, there are countless of them, but you got to be a little bit more picky. I like a little bit more when the market's not trading right at the highs, and we can get a couple of those decent moves, because it enables the market in general to help boost everything else. Like, you're not like, if you're going to be chopping around here at all-time highs and just kind of wedging down, forming this nice little flag that we broke to the bottom side of, well, you have to have such an unbelievable setup in order for those to actually fire off significantly. Like, yeah, we've had a couple that have followed through, but a lot of them are just, oh, we're going to have like make it free first day, and then they chop around. When you see these types of sell-offs, guys, this is when the really, really, really big and fun trades can form. So, again, everybody, we talked about this in the beginning. Everybody gets 2 weeks free to the private mentorship community. Remember, this is not an alerts community. This is for me to teach you to see everything the way I see it in the market and walk you through how to execute in real time. You guys get access to all the courses that are like the video series that are actually going to show you how to do this and exactly what I do in the market all the time. Then we have the private live streams every single day. Well, except for Fridays when we're doing the public live, but every other day, where I'm live trading for you guys. We're walking through all the trades. I'm showing you guys my thoughts and exactly what we're looking for. You guys get the pre-market plans if you can't come to the streams, the macro research reports, the single stock research reports, the watch list. It goes on and on. But this is the last month for everybody to get their first month or 2 weeks free. So this is 2 weeks free. And then at the end of January, guys, the prices are going to be going up. Remember, I only want the serious people in there that actually want to learn, and not these people that are just like feed me alerts. Because one, we've talked about this before, that doesn't do anything for you. You're never going to learn anything. And in order to have long-term success in the market, you have to understand 3 things. One, the full reasoning why you're taking a trade. The second is exactly how you are going to manage the trade when you're in it. You should not be thinking to yourself, oh, I'm going to enter a trade and just wait for somebody else to tell me what to do. I can't even tell you how stressed out I would be if that was the case. And that's what we were doing. Not in terms of like in terms of like if I had to do that and say, oh, I'm going to just follow along with some nonsense, like I'd freak out. Then the third thing is understanding exactly when you are going to exit and why. If you can fully understand those things, what does it do? It gives you the highest level of confidence when you are trading, which leads to better decision making. And as I always say, money is a byproduct of good decision making in the market. So, Ralph, you got your VIX move finally. There you go. So I'll throw that link in here for you guys. Everybody gets 2 weeks free. This is really the time to come in and learn too while the market's doing this, as it's going to start setting up some unbelievable setups for us going into the new year here. It's very possible that we end up selling off down into this 586 to 582 range here, which I'd literally be thrilled about, because you can start to see these curls and you can get some really giant moves. We're not hitting these 500 to 1,000% trades consistently for no reason. So again, if you guys do want that, click that link right there. But at a bare minimum, you should go click that link and go read the reviews. Just understand why I only have 5-star reviews on there for a reason. So team, that's kind of it for today. For all of you guys in the Discord, I'll probably see if there's any charts out there that look interesting. But with this kind of candle after FOMC and going into the holiday week next week, there's not going to be a whole lot to do. We're really going to be talking a lot about macro, seeing how the market reacts to data. And that's kind of what today is. Today is really just like, yeah, we got the new SEP, which the market's reacting on. But what today really does is tell you how to read the next rounds of data. If the Fed's inflation projections for 2025 are now higher, what does then that do to the market if you get a soft CPI print or a lower than expected CPI print? Well, obviously the market's going to buy it up a little bit more than it would have. If you have some slightly higher or right at expectation CPI prints, it's not really going to do a whole lot because the market is now pricing in that right now. Do you think this is a longer term bearish or just an overreaction? Okay, so right now, the market already wanted to sell. Going into the end of the year, after the year that we've had, the market already wanted to sell. What we saw today, if you think about it, is really the Fed can't justify now. Like they would, if they could have, they would have. The Fed cannot justify now cutting rates. Why? Because the economy and the economic data is stronger than they thought it was going to be. Now, if unemployment starts to tick up here, that's really going to be bad with high inflation. But if they can keep the labor market under control, things are going to be relatively all right, I think. Again, this could sell off. We want a big sell off, though. Like, how far away are we from the highs right now? 2%? Yeah, 2.5% all the way down to the zone here gets us to 3 or 4, even almost like 4.5 to the bottom of the zone. That's a great sell-off in the market. That's awesome. That's exactly what we want to see. And these are the times in the market, guys, where you actually make the most money, not because of the things that you do, but because of the actions that you don't take to preserve capital and wait for these epic setups that are going to be coming. You've been warning us about where the market has been. No, I know. I mean, I've been. It's just storage right here, man. I don't know. You guys keep saying I'm in a locker room, but like I've been talking about this. Like I didn't think that this market was going to hold up into the end of the year. This is something that we've been talking about in the Discord a lot. But again, make sure that you guys take advantage of that 2-week free deal. That at the end of this month, that's the last time I'm ever offering a 2-week free trial. At the end of January, prices are going to be going up significantly. So again, you guys want to have long-term success in the market and be prepared to take advantage of all these epic moves that are coming. We'd love to have you in there. I know for a fact all of you will have success if you watch the videos and pay attention. And then in January too, we're going to start doing a lot of those trade recap videos too, to just continually expand on your learning. Because that's what it is. It's a mentorship community. It's not this nonsense, excuse my language, bullshit alert nonsense that everybody else does that doesn't do anything for anybody and keeps you dependent on the person. I want you guys to be self-sufficient. You guys come in for a couple of months with me, you understand what you're doing, you get the setups. If you want to stay and look at the setups that I have, great, because they're always going to be really good. If you want to go off on your own, that's exactly what it's for. Were you streaming from a closet? I was never streaming from a closet. All right, we're still selling here. This is good. Market's at low a day. I love this, man. Keep selling it. Keep going. Again, I don't really honestly, I don't really want it to be that big, but if we can slowly pitter patter our way down through the rest of the year to this zone and then start to bounce back up, shift the trend, like there's going to be 500 and 1,000 percenters everywhere, and you guys are not going to want to miss them. They're going to be everywhere. So all right, guys, we'll probably wrap it up here for today. All you guys in the Discord, I'll see if I can find some charts tonight, but we're probably just going to be looking through things at market open tomorrow on the private stream, and then Friday for you guys, we will be doing another public live day. So make sure you guys have notifications turned on for the channel. Don't miss that. We'll be back Friday morning with you guys. You guys get to see us during the morning, see if we get any really fun trades. There might be a post earnings setup. Who knows? All right, team. I'll see you guys later. Peace.